So, JP, are we live? We're live. Excellent. So, thank you and welcome to today's event on access to finance. I'm delighted to see some of you in person, so thank you for coming on and joining us here this evening. And a big welcome to those who are watching online. Wave as well. My colleague Helen is online, so I'm just going to send a special shout out to Helen. Good evening. Just checking that everything's working. And this is a 3-day series of events on access to finance, which Ukie, the trade association, are delivering in partnership with the Barclays game and esports team. And it supports a brand new access to finance guide, which has been published by Ukie and created by Harbottle and Lewis. Is this going in and out all the time when I'm speaking? No? Okay, good, just checking. Yes, so Harbottle and Lewis, and we've got Mark here this evening from Harbottle to talk to you. For all people that have registered for the event, you'll be sent a link to this brand new Access to Finance guide. It's one of our most read guides on the Ukie website. It helps businesses understand all of the different ways that you can bring finance into your organisation. Now, we had an event last week, our first event, which was a virtual event, a webinar, and we looked at grants and public funding. We looked at video games tax relief, angel and VC investment, and a variety of other things. And today we're looking at longer term funding, so later on in the life cycle of the business. Our third and final event in this series is taking place on the 6th of December, and it's going to be called, or it is called, Navigating Economic Downturn, and looks at the cost of living crisis and the impact that could have on games companies and how they can work their way through it. That is an in-person event at Market Street in Manchester, but it'll also be on YouTube, so our audience can join and watch that. It starts at 4:30. Again, everyone that has come and signed up for any of these events will be sent links to all of them, and also a recording of the videos so that you can catch up on anything that you missed. So back to today's event. It's interactive, so feel free at any point, audience, to ask some questions. We'll do that after each of the speakers. I'm going to show you the running order for today. So today's content, that's just who I am, Sam from Ukie. These are the earliest slides. So we've upgraded JP to Elaine from Barclays, who's going to welcome us all in a second. And in so many ways, an upgrade. And as you can see, Neil is joining us from the London Stock Exchange. We have a panel, and then I'm going to do a little interview with Nick Button at the end. And for those that are here in person, drinks and pizza will follow later on. So worth sticking around for. Now, as cued and introduced, Elaine, you're going to come and do a short welcome after the Barclays team.
Thank you, Sam, and a compliment from you is much appreciated. Thank you. Can you hear me? Hi, everyone. I know a lot of you already. Lovely to have you here in one of our kind of flagship branches. I got a lot of comments as people walked in that they don't expect a little auditorium in a branch. So now you know it's here. If you ever want to have an event, talk to the team here. You're more than happy to you can use the location. For those of you who don't know me, I'm Elaine. I lead strategy within Barclays for games and creative industries. And we have a dedicated team that just work with games businesses globally. And it's fantastic today to have colleagues from the corporate bank here today, from the investment bank, and from the business bank who are going to be on after myself, or a bit after me. And also as well, I wanted to say a really great thank you to Sam and his team. We've worked on a number of initiatives with Sam. Currently, we're running a mobile scale-up program with the lovely Nick around over there. He's helping us with that. Again, we're giving 15 games, mobile games business, the opportunity to develop the business acumen, skills, and the amazing knowledge from legends like they on how they can grow their mobile businesses. Through to a number of events like the book crawls, demo days. So it's fantastic to be able to do this event. It's a little bit more financy. We are a bank, that's very good. So thank you, Ukie, for that. And on that note, we don't really need to hear more from me. So I think
Thank you very much, Elaine. And I'm going to invite Neil Shard. Yeah, we have one microphone, so when I want to ask you a question, shout at me. Be prepared. Get your slides. I can see that.
Hi everyone, how are you all doing today? Fantastic. So thank you very much, Stan, Elaine, Calvin, Ryan, team at Ukie for hosting me here today. Lovely to meet you all. My name is Neil Shah. I head coverage of the tech sector at the London Stock Exchange, and here we're just really here to talk to you about IPOs, what we can offer, and to help you hopefully stay objective as you look to grow some of your video games businesses. So without further ado, I'm not sure how much you know about London Stock Exchange Group. We're about £50 million of market cap in the FTSE 100. We employ about 25,000 people worldwide. I met 5,000 of them in Bengaluru the other week. We scattered around the globe. And when it comes to companies on our exchange, we've got about 2,000 companies on the market. About 10% of those are tech and tech-enabled businesses. And one of the areas which has made investors money is video games. So think back to Codemasters, Sumo Digital, both made significant returns for investors. Since then we've had Frontier Development, Team 17, Keyword Studios, which is still on the market. And last year we had a couple of US video games businesses listed as well. You might ask me, well, what are the US companies doing coming to London? Part of that was us reaching out to these companies, but also them realizing that London's a market where we can take the companies of all sizes. You don't need to be a unicorn to qualify. And you'll see this on the left-hand side. If you look at the average market cap of a business in London, it's about £500 million. The median is much lower. And a lot of companies are on AIM. In fact, all of the video game companies you see here are on our junior market AIM, which is 27 years old. But allows you to do an IPO, should you wish, in 10 weeks, follow on fundraise in 3 weeks. Without a prospectus, you can move pretty swiftly, and that's partly why keywords are still on AIM today. So without further ado, what I want to do is just walk you through why don't you think about going public in the first place? There's a great podcast by Reid Hoffman, who built up PayPal and LinkedIn looking at M&A versus IPO. And what he says is that the motions you go through getting ready to go public really make you a more attractive business if you're going to be acquired as well. So the first point is really about financial independence. We like venture capital. We've got a number of firms listed on our market, like Molten Ventures, Augmentum, some of the private equity funds like Bridgepoint and HG Capital. Everyone serves the purpose. But typically, when you do take VC or private equity, it comes with a finite life. Those funds need to be repaid after 8 to 10 years. When you raise money by the stock market, that capital is yours. Yes, investors want to see a return, but being on a liquid market, they can buy and sell shares pretty easily. So if going public, it's often companies come here to fund their growth, to raise primary capital, sometimes to recapitalize shareholders who have funded them to that point. Having access to funds pretty easily. To do a private round, you're probably looking at 2 or 3 months of private fund time to actually do a fundraise. Being on the markets means that you can raise capital pretty quickly, and it's a liquid and transparent market. A lot of our CEOs tell us that it helps them raise their game. The fact that you've got some accounts out there means that hopefully you're more credible, not only customers, but also suppliers and partners. You can use your shares to incentivize staff aligned interests and also attract new talent. And M&A is often a tool used to augment your organic growth. You look at Keyword Studios, they've done over 50 acquisitions, and being able to use your balance sheet, but also equity and debt can help with that. Being public allows you to really focus on what matters, running your business. You're not having to constantly raise for the next round or think about an exit. Most investors are passive, they're not going to ask you for a board seat, and you can get access to investors around the globe, from Europe, from the US. So that's a bit about going public. So let's look at some case studies. Last year we had Tiny Build. So this is a indie developer publisher from Seattle. They raised about 154 million pounds. To use a Berenberg transaction, you'll see the shareholders who came in, and the size of that business, revenues are about 56 million pounds. Good growth and profits. Valuations were a little higher last year. I think this deal was done at about 21 times forward EBITDA, but it's come off to about 7.6 in this market. So here's a little bit on the reasons why they chose to list. And Alex here, the CEO, was a majority shareholder together with COO Ukie. I'm sure they'll be delighted to speak to any of you about their journey and what it's been like it being listed on the market. So that's Tiny Build. Just take the keywords. Today, this is a 2.1 billion pound business. Look back at where they started. They raised about 28 million pounds, 50 million pounds of market cap back in July 2013. And as I mentioned earlier, they've done 50 or so acquisitions in the market. You really don't need to be a unicorn to get started. The smallest IPO we had in the tech sector last year was North Coders, market cap of about 13 million pounds. It's a trading school based in Manchester. Their shares are up about 80%. The largest was TransferWise, 8 million pounds market cap. Both work pretty well, and I think that applies equally to the video game sector. So this is keywords. A little bit on their story. See, Andrew Day had to step back from that business, but it continues to do pretty well. You've got Team 17, so they joined the market in 2018. Debbie, I think, was about 48 years old when she decided to list her business. So this isn't a thing that's only accessible to youngsters. We see a number of founders, diverse range of founders. Markets really open to people of all kinds. It boils down to these businesses themselves and how strong the business story is and how strong the fundamentals are. So I think when Team 17 listed, they've done about 10 million pounds in 2015 of revenue, about 13.5 million pounds the following year in 2016, 2017, about 30 million pounds of EBITDA. And if you look at where they are now, they're sort of targeting 138 million pounds, just showing you that you don't stop growing once you're a public company, and that's why they've got the support of some of the investors you see on the bottom left, some of whom may be managing our pension funds. Devolver, so this was also backed by NetEase, twice the size of Tiny Build, about $950 million of market cap when it listed. Both businesses saw something like 117, 118 investors, all remotely, sometimes in the space of 2 weeks when they did their IPOs. But so we've got a pretty well-oiled machine that works well here in London. And yes, their shares have come off. They committed the cardinal sin of issuing a profits warning once you listed. It's really important you don't do that. Try and manage those expectations down and do it the other way. Make life a lot easier for you. But sometimes these things do happen. But they've still got support from some of these long-term shareholders. And I guess one of my favorite stories is that of David Braben, who I'm sure many of you will know. I think David was a similar age to Debbie when he decided to bring Frontier to the market, and they raised a mere £4 million. Pretty much a bootstrap business till July 2013. I think 3.3 of that went into the business, and they've continued to do tremendously well. If I think back to the scale, it was probably around 13 or 14 million pounds of revenue, and you see it today, it's up 10x as is the valuation of the company. So that's an overview of what we've got on the market today. We've also got the Hero Capital SPAC as well. They may have actually called on a few of you. So we've got a number of folks at SPAC as well. I guess why do we see hundreds of SPACs in London? We've just got a really well-oiled machine that allows companies to use the front door rather than the back door. You don't see the prices going up 100% on day one. And I think that was why there was a big call for SPACs and direct listings in the States. You can do that here. Why straight to direct listing? They didn't need any capital. But I think our IPO mechanism works pretty well. And if anyone's interested in learning more, please do get in touch. We've got a team of 20 scattered around the globe, 6 of us based in the UK, but I spend my days talking to people like you and hopefully helping what we can. Thank you very much.
I have a couple of questions for you. See, relax. It's not, is it? I feel like I'm hiding behind the glass here. I love this. So the most controversial panelists later will be sitting here so that if anyone throws the objects, get through. I love that. I learned a lot there. And I remember in particular the case studies when Tidybuild went through this process. It was a surprise to a lot of people that a company of that size was able to do this. So is there a sort of a minimum threshold for companies to start doing this process? And what did you think when they came to you in the first instance and said we want to go through this?
Sure. So Sam, there really isn't a minimum size. As a banker, my smallest IPO probably had about £1 million of annualized revenues. I would recommend starting like that level because you create a bit of a rod for your own back. It's hard to find investors who can support you on that journey, but it's absolutely possible. It really boils down to how exciting that business is. I think where Tidybuild started, 50 odd million pounds of revenue, you're a sizable business. You're probably in the upper right quadrant, to be honest. And it's a good place where you get support not only from UK investors, European investors, and US investors, who are typically looking for a bit more liquidity in those shares. When they called up, I was absolutely delighted because you just assume that a business based in Seattle may default to the US, but we spent a long time educating companies that to be relevant in the States, you're really looking at $20 billion plus, and that message is the same for a Klarna or a Revolut or a Checkout.com or a semiconductor. In the UK, you've got scarcity value. Investors are global at the end of the day. It's exciting enough to come here and thank you.
That's one for the London crew. That's a good word, isn't it? To attract them to the business. Are there any questions from the audience? Question over there, sir. Do you want to? What's a
Sure. It's a special purpose acquisition vehicle or a company. So we've had cash shells in London for years. Companies essentially where they may have sold off their businesses, just sitting on the exchange. Until last year, if one of those vehicles was to make an acquisition, their shares would get suspended. In the US, the rules are quite different in that the shares will continue to trade, and they just had a slightly more flexible regime. So you saw a number of SPACs and celebrity SPACs in the States. We didn't have as much noise and excitement here. We had small companies that were able to use the front door.
Thank you very much. Another question over there. So,
yeah, how much of a burden is it on management to do public company reporting? How much time does that take up? How much of it is scrapped from the How much can you guys handle that?
Sure. Question of burden of reporting. No one likes admin, do they?
No one likes admin. I guess what would you rather have? It's really horses for courses. If you are going down the private equity route, having someone on your board where you might be doing regular reporting is one avenue. In terms of the public markets, in the UK, you typically reporting half yearly. Some companies choose to report quarterly. And you may see investors twice a year. They tend to be quite passive because they own 10% at most, typically 3 or 5 for the larger funds. A lot of disclosure is done in a sort of to many format the annual report for brokers in terms of their investor engagement. And so most CEOs they probably spend about 2 to 3 weeks of their year in actual IR related activity, but I might think that's probably a little less burdensome than private equity, but it doesn't get advertised as well as I would like.
Wonderful. Thank you very much, Neil, for joining us here today. I'll share your details and your slides with everyone. So thanks for joining us.
Thank you.
Okay, we move on to our panel now. So if I can invite Ryan, Gavin, and Mark to come and join us. Mark is the unadvertised Mark, but another upgrade, Mark. Say that. And your host for the panel is going to be Amanda.
Can you hear me? Wow, okay. So thank you everyone for coming in. Very quick introduction. My name is Martha. I'm one of the relationship directors in the sort of creative team in banking. I've got Ryan from our investment banking, Gavin, who leads on the business development, and Mark from Harbottle Lewis. So without any further ado, I think just for everyone's sake, I will get straight on to the questions. But apologies, I have got on my phone. I'm not being very techie. If you do see me going kind of up and down, it's probably because I'm trying to make sure the questions are right. So I think the first thing is probably funding, right? I think that's really important for everyone. So if I start kind of with Ryan from my investment bank division, one of the really key things for, I guess, not just banking, but also for our clients here is what is the appetite or sentiment in the market? And then just to follow up on that is what do you think, I guess, investors are looking for?
Yeah, thank you. I think it's important to distinguish between sort of the sentiment versus the market and gaming. So obviously we've seen a high inflation environment, high interest rates, we've seen a lot of de-rating in share prices and valuation this year. And obviously that's been quite broad-based, gaming has fallen in under that umbrella. But looking at gaming more specifically, I think companies at an operational level have had difficulties in terms of game releases, meeting their dates there. Some issues around cost inflation and margins as well. So there has been some mixed sentiment, probably is the best way to describe it, I think. But I think withstanding that, people are still cognizant, recognise the fact that gaming as an industry and the entertainment sector is probably one of the most high growth ones that have structural growth underpinning it going forward. So although it gets bucketed sometimes and they're a COVID beneficiary, I think people do see the long-term benefits and long-term upside in the gaming sector.
And as rosy as it is with regards to obviously appetite, another flip side of it is what are the key concerns in the market and what's your view on that?
Yeah, so I think some of the key concerns investors have typically around the poor visibility of revenues. So not being able to sort of model out for investors in companies 2 to 3 years down the line, having that visibility is very important. Subscription models also help some of these companies in that respect. But I think that's quite a key area of focus. Another one's probably around, in this environment particularly, is around return on sort of cash spend budget. So making sure you're deploying your capital as efficiently as possible to ensure you get the best returns there. I think that's another key area of focus. And I think in a market that's quite fragmented and consolidation is quite a key part of it. I think investors are quite keen to see people really disciplined around M&A. So not overspending, acquiring businesses that's in line with existing strategy, and then those sort of things.
Last one for you, I'm sure we'll have more, but with regards to, I guess, games, historically it's always been regarded as a risky investment. So has that changed? And if so, why do you feel that's changed?
Yeah, I think it's difficult to get away from the inherent risk that some operating models in gaming they have, but I see it no different and no less risky than some new technology businesses. Some there probably have more risk, and I think we've seen over the last decade or so businesses on the London Stock Exchange in particular, the institutional knowledge to be built up there quite substantially. And people are still alive and cognizant that they're aware of what the risks are. So I don't think it's seen as dramatically riskier than other areas of the market. I think also another thing that's quite important is there's been a lot of growth as well in the sector. So I think that's helped to de-risk it from quite a lot of people's perspectives. And I think you'll see certain case studies on the market. I think a great one's probably Keyword, but a company that sort of consistently delivers throughout its time gets rewarded in an area that's quite difficult in terms of its lumpiness of revenues. I think what they do really well is sort of consistently beating and delivering and have a good association and have that track record.
So I guess that's quite interesting just to give an overview, but one of the things I really want to probably bring it back to now, Gavin, is we've seen quite a few changes in terms of the mergers and acquisition market. So I guess why do you think we're seeing that substantial increase, and what's your views on that?
Yeah, I mean, there's so many reasons. I guess I come at it from a wider sort of industry perspective, and you look at the amount of investment and success stories that are coming out of the UK alone. I guess in the industry, that's always going to help drive that. Sort of new technologies that
supporting, let's go with that. Supporting the industry, not just about business anymore. It's like let's support sort of even games. It was competition that we've been here. You've got businesses who've been around a long time, sort of growing organically, and then sort of you've got a lot of new competition coming through. That's always going to be a consideration for them to kind of try and say, well, actually, I'll take that in as part of our type of structure. And I think when I've seen over the last couple of years, sort of flurry of activity, I think whenever there's sort of a big market acquisition or big market investment, there's a strategic period of time that's soon. As you look at the start of this year, you had sort of 3 very large sort of active there yet, but and then suddenly there was some boom of investment as part of that as well. So it's that seems to be the trend that I'm seeing so far. And then so I think that when I look at some of the numbers, I think they've come pretty steady. Market this year, about £27 billion of spend. Again, that's not including the larger one that is again still to be finalised. But you then got Take-Two's acquisition team as being sort of the larger of that in those numbers, and then sort of a lot of the new technology coming through blockchain, on the game side and technology and platform. So that's really driving that up as well. But yeah, in the last 5 years, I know me and Brian discussed this quite a lot. You look at some of the multiples on what sales or your EBITDA. This is just in the UK alone. You've got about sort of 3.5 times on the revenue, and then you've got sort of around 12 times on the EBITDA. So those numbers are not to be pretty decent, just in the UK alone. Obviously, when you go outside and go globally, they're even larger. So the industry has shown itself to be resilient over the last couple of years. We are it's in a really strong position. So acquisition is always going to play a big part in this sector. So yeah, obviously it's something that's too much anytime soon.
What's your views on that position?
Yeah, so I've always been monitoring the deals market over the last 10 years. And I'd say that they used to be a trickle. We maybe saw a decent deal by a quarter. During lockdown in particular, it went out. We were seeing 3 deals a day that were eye-catching. So you ask yourself, what was this all about? There are the issues that Gavin's identified, and I think, though, what's really happened is the way the industry has grown up, evolved. People used to see it as a head spread business. You had to get your game out of the top. Traditionally, historically, packaged goods. Packaged goods. That's okay. Okay, right. What's happened since? Obviously, everything is not everything, but a large proportion is online. But also, most games companies historically made most of their money within 3 or 4 months of when the game was released. That's no longer the case. And in effect, you've had a structural shift. from a business model perspective, where there is revenue constantly coming in post release of the game. You know, the sort of trying to apply SaaS type of concepts, games as a service type of concept, where there is constant revenue, therefore there is more reliable cash flow, which is attracting acquirers and also investors. I think there's also what we saw, particularly over the last year or two, was a kind of fear and greed. Nobody wanted to be left out. Money was incredibly cheap. You know, we identified the reasons why it's changed in the last 6 to 9 months, but it was incredibly cheap. If you look at, for instance, one of the most acquisitive companies in Europe is the Barclays Moorgate, based in Sweden. They raised, if I can say this, cheap money through Nasdaq North. On the back of that, they acquired lots of businesses which boosted their share price. They bought a lot of companies using paper, meaning their shares, it wasn't costing them cash. So, and it was absolutely confirmed mid this year when the Saudi state fund paid, I think it was $1 billion for 8%, to do the maths. Okay, and this is the Embracer Group, which was practically unknown, what, 5 years ago, 4 years ago, relatively speaking. So that gives you a sense. I suppose I should end just by saying, obviously, since Q1, you've seen a massive contraction. Okay, you know, in the first quarter, investment deals as opposed to sales, I think it's about 2.7 billion. That was up by more than up. Well, I think it was 1.3 billion in Q1 2021, but in Q2 it had dropped to 1.3 billion. It's still fairly sizable because there were still deals in the pipeline. By Q3 and Q4, that is significantly less. We don't yet have the figures, but I can absolutely guarantee it's going to be significantly less.
Probably should have handed this back to me because the next question is actually for you as well. So just kind of thinking back to that is, what are some of the things that games companies need to sort of prepare for if they're looking at a sale? How can they best prepare?
Okay, the first thing I think anyone's got to ask themselves is, what are they looking for? Are they looking for money, you know, with a view to possibly taking time off? Are they looking for money for their business, to reinvest in their business? Are they looking to stay on and effectively take the business to the next stage? So I think the first thing is, whoever is the owner of the business, the entrepreneurs, etc., they have to be realistic with themselves. That's the first question. Second point, get your house in order. Okay, it's a very stressful time starting a business or even doing an IPO because you're trying to run the shop, and yet at the same time you're dealing with the likes of me, a lawyer, bankers, corporate financiers, accountants. It's incredibly time-consuming, very demanding. Ideally, you have one person who looks after the shop, the business, and you have another person focusing on the process. What you don't want is the business dwindling and the value possibly being under threat whilst you're going through effectively one of the most important deals in your business life. Third thing, make sure a key part of any deal is the value of your business. Underpinning that value, any investor or buyer or stock exchange or institutional investors will be looking to see whether the fundamentals underpin that particular value. And what that means is, in some cases, they will look to find holes in your business. So, for instance, if you think, what is the key to the value of any business? Your IP. Make sure you own your IP. Make sure there isn't somebody that's held on to the IP. Your staff. This is a people's business. Are your staff committed Are they incentivized? Have you given them options so that they can take money off the table time and again? Okay. Are your contracts in order? Are they, some of them, going to suddenly disappear because your licensor is going to terminate if there's a change of control? Go on, but it's a talk in itself, so I'm going to have back to you.
Okay. And I guess that's very useful because I think sometimes, even from a banking perspective, we very much get missed in the sector of transaction. Having that overview, I should come to you afterwards. But with that, kind of the next question is, Gavin, with a major proportion of this in terms of sales, obviously coming from overseas, why do you think that is? And do you see that, I guess, continue in the future?
Yeah, so again, sort of multiple options, I guess. Changes coming over the last few years. I think regulation changes in certain parts of the world has kind of forced some of the sort of key players to invest a lot more in Europe and the UK, which is obviously a really good thing for us. So there's obviously going to be things like that happening across the world. So we've got to keep track of that. I think that the trends are quite clear in terms of who the key players are. You know, I don't know if anyone saw actually. There was someone took the time to put together a sort of an acquisition wheel on LinkedIn of all the sort of key players. It was quite amazing just to look at how many companies have been acquired by these people, these companies. So obviously basically growth in Tencent, Microsoft, and Sony. So yeah, it was. It really kind of brought it to life just how much they've, how many companies they've acquired, not in the UK. FX rates will always obviously be a part to play in that. Obviously, at the moment, people are going to probably get a much better deal, especially if you're, buying it in dollars and a company in the UK. So that always be aware of what that is, make sure that you'll get the best deal for you as well. I think that you can't just take that, take that into consideration because obviously that will play a part in the person to acquire you. So we have some specialists that can help you with that conversation as well. I think both myself and Mel have kind of been working in across the wider creative industry for quite a long time. And actually the quality of the infrastructure we have here in the UK has always been quite attractive to overseas companies. So just looking at Netflix as an example, obviously they've got money games as well, but they've set up quite a large shop in the UK, alongside people like Amazon as well. So that I think we've got the talent, we've got the infrastructure, which is always being sort of pushed and moved forward by Ukie. So that's always going to look attractive to companies overseas as well. I think the question is it a good thing? I think that's always up to debate. I think well, luckily I get to see sort of the tail end of what happens after these acquisitions, and the real positive I think that I'm seeing is that I saw a comment once on LinkedIn about always there could be any independent left, which is kind of got me thinking. But what I see is that sort of once maybe 12 months after an acquisition or something like that, new companies being started, and from quite senior members of staff who've been acquired, and they said, actually, I want to give this another go and shall start again. So, it's kind of a domino effect and cycle is going kind of round and round. So from the UK perspective, I think it's a really positive thing. And the industry is really taking hold of that.
Thank you. So this question, I'm probably going to aim it to all three of you. I'm just going to throw a curveball in there. It wasn't going to be just for Gavin and Mark, but Ryan, I'd like to be involved. So what are the funding options for mergers, acquisitions? And my next one is management buyout. Like, what are you seeing, I guess, of anything in the market? And I'll probably take it to all three of you just to give me an overview.
Yeah, sure. I think it's I think the public equity market is a great route for financing. I think there's been lots of compounders today, especially within the gaming sector. It's thriving in terms of M&A. So I think that's an obvious source for fueling M&A going forward. I think investors are very willing to put money to work, supporting companies with quality M&A. So I think as a funding option, once companies are listed, that's clearly one of the tools that they can use for disposal. Yeah, I mean, so other types of investment, early stage investment, injection of cash into the business, that's, discussion with, VC, the angel investor, whoever it is that conversation to have, and a really key option, especially if you're at sort of an early stage in the business. I think, from the bank side, we do have specialist finance teams, and we do have a acquisition of M&A and NPO capital finance model. So it's for companies that are really kind of that sort of mid-stage, so sort of trending EBITDA over 3 years about $500,000, and sort of that's kind of where we can step in for a finance option. So it's always been something that we've done at Barclays on a corporate level. We dropped the requirements slightly in terms of the EBITDA level because we want to spread a much broader spectrum. And for us, Mark alluded to especially when you're going through these conversations, all the analysis that we will do, who are you buying, how's that going to affect the company, if it's an MBO, who's the new management team coming in, what's their experience, so there's a lot to it, but there are options out there, and it's not something that we can directly help with. We have a wider network in the industry, so we'll always try and find sort of those right connections that can help you with that next conversation.
I think it really depends who you are, what you want money for. If you're an acquirer, you're trying to acquire another business, you can use cash, in which case you're either looking for your own cash or more likely we're talking to the likes of our colleagues here. Secondly, you're going to be offering debt. That could either be borrowing from the likes themselves, or it could actually be you buy a target company and you don't pay it all up front. So in effect, the seller is lending to you, the buyer. The third thought is, of course, paying with shares. And all of that is down to what your fundamental value is and the value of your shares. And of course, it goes back to one of the attractions of going on the market, Neil's point. On the market, you've got some very strong paper or shares, which effectively have an additional benefit for a seller, because in theory, the seller, once they've acquired those shares, can go and either hang on to the shares if they think the business is going to increase in value, or they can cash out. So they can have the best of both worlds. So I think, the answer to your question really is, it depends who you are, what you're looking for, and where you're sitting at that particular point. Oversimplifying. Yes.
I think if you start out, that's how you do it. It depends. It always depends. So I think it's an absolutely fair point, and so many things have to be taken into consideration, but never know one situation is going to be exactly the same till so that for us as well as Mark point of view and us from a banking point of view, the closer we are to your business and what your plans are, and the more we know about that, that's going to make it a lot easier when those conversations are being had. So yeah, just it's a mad world, but that we are his support.
Thank you. So Mark, with that, it depends. The next one is, what are the key differences for a business if they're looking to, I guess, sell or consider between financial investors or strategic investors? I think that's always in the minds of people, and I think it'll be good to just clarify as well.
Okay. I think there's a very simple distinction. I would say in the games business, there's when people talk about institutional investors or whatever, often people are talking about private equity. I think it's fair to say, as opposed to trade, which is basically people in the industry, one company buying another. Absolutely fundamentally, you're dealing with private equity or you're dealing with finance-driven buyers. they're going to be interested in the money. They're going to be interested in an exit. Okay, that impacts on timeline. So in other words, if you're private equity, okay, it's not usually your own money. It's money that investors have put into your fund. They're looking for a timeline, the investors, to get their money back. That puts pressure on private equity to look for businesses where they know that they can flip them on. So they'll buy them, but they'll look to sell them for 5 years. Equally, by their very nature, they're very sophisticated in terms of finance and looking at your cash. You know, Neil again made the point in answer to the question about ongoing reporting requirements if you're on the stock exchange. He made an absolutely fair point that in some respects it's nothing compared to the kind of reporting and accountability that you running a business would have if you're reporting to your new owners who are private equity or institutionalized investors. Okay, as opposed to a strategic buyer. Well, they're going to know your business. In some respects, it could mean they won't overvalue the business. Again, it depends what they're looking for in terms of the business. Also, if they're not taking 100% stake, problem is, if you've got a trade investor sitting in your business, it more or less limits, in many respects, the obvious buyer for your business, and therefore, in some respects, depreciate the value subsequently. So again, I'm sorry to use the phrase, but it depends. Okay.
I think we're now almost there. My next question is, I guess it probably relates to the London Stock Exchange, so it may be one. But Brian, where, from your experience, when is the right time for companies to think about IPO? Why should they IPO? And how can they best prepare? So I think that's always going to be actively in people's minds, especially with the last 3 case studies that we've seen. It's something that probably pops into people's minds to go, okay, how do I sort of action this, or what's the first thing that instigates out of people's minds?
Yeah, sure. I think Neil touched on some of the reasons why people do look to IPO. Obviously, it's good source of access from currency once you're listed. Increase your profile as a business as well. It helps in your dialogue with M&A and with other customers. And in such a creative industry as well, it's obviously very important to stay talent, and having that profile and sort of share and centralization helps with that. I think in terms of what companies can do in the lead up and think about an IPO, I think it's very important to speak to investors early on in the process. Investors obviously want to see you normally a couple of times for an IPO. And it's always better to have that sort of relationship build up over time, because they can be obviously the owners of your business. I think it's underpaid quite a lot, but I think you can't downplay the sort of engagement with research analysts at the investment bank as well. So often these are the people that be going on the road, seeing investors and telling your story. So I think it's important to dedicate time with them early on in the process. I think it's also important to think about the board structure as well. I think investors quite like to see you having a board in place around 6 months in advance of an IPO. And it takes time to find the right people and right skills. You need to find the person who's a good fit for your business as well. So I think you have to start that process quite early. And I think also, as you sort of saw earlier from all the case studies, there's obviously a number of businesses that are listed on the market at the moment. So you've really got to put a lot of time thinking earlier on into your equity story, how you position yourselves, KPI benchmarking, where you sit within the spectrum. Obviously, investors want to see a new business, something that's a bit differentiated to what's there and what they can buy. So I think that's obviously a key area to think about. And we've touched on reporting and internal processes. I think you can look to engage with IPO readiness reports, see how you are, how well you are set up to basically run a public business. I think those are the things.
Thank you. So my last question is probably going to be aimed at everyone again, because that's how I like to do things, not run by protocol, is what are some of the funding options available to companies? Because I think that's always key when we see anyone from whether a startup to thinking about IPO. It's always a challenge, especially kind of quite relevant to funding. What are you seeing in terms of opportunities for long-term funding?
Yeah, I think there's multiple sources of finance that companies can look to access the whole way through their life cycles. So obviously, from the earlier stage, we have seed investors, angel investors and VCs, all the way through to private equity, and up until sort of institutional investors once listed. So I think it's important to keep in mind there's a broad spectrum. All have different needs and wants, and all are relevant depending on where you are and what your needs and requirements are as well. So it's the matching process.
It depends.
It's it depends. It's just touching on I think it's a bit of memory, something earlier about the opportunities from banking point of view. I think something that's come up a lot of discussion I'm having with companies in this industry is when they're looking for that sort of long-term finance, how do they value in business and what we what's actually what's value in business, and obviously IP is talked about a lot, and so something that we've often said to look at recently, and I'm sure something that market involved in quite a bit is helping them understand what the value of IP is, so they can actually go to have when they're having these conversations, they've got a much more stronger argument, I guess, so what they're putting forward to the person who's acquiring, you need to go for this, so so we've engaged with some companies that can help with that valuation, and we've also engaged with experts who kind of come from other parts of the games industry, set up some consultancy firms, they can have those conversations, and then so when it comes to have the conversation after with myself or the investor, they've really got everything ready to go. But I think following what we were saying earlier, it's just the bits that I think so a lot of funds at the moment, and I'd say the key area is focus on.
Easy to say, depends. One thing I would say, that was more attractive superficially up until maybe 6 months ago because of the rates. I wouldn't say money was cheap, but it was a lot cheaper than it was now. You look towards equity investors to invest, whether it be as a startup, angel investors, or whether you're looking even to go at the other end of the spectrum, floating. Effectively, you have to acknowledge that you're giving away part of your company shares. And in some ways, it's very tempting to bring in investors, particularly if you think you're maintaining control. But if you give away your equity too early, you could find yourselves being diluted incredibly quickly, because the chances are you're going to have to go back and seek more money in various stages, which means that what starts as maybe as 80-90% stake you might have in the company very rapidly becomes maybe 10-20%, which means you lose control. So equity, it's a good option, but my view is always try and avoid giving shares out too early, too quickly, because you'll undervalue yourself. There are more creative forms of debt. There's people call velocity funding, particularly useful in the mobile sector, where there's a rapid cash flow, rightly or wrongly, where people are lending against effectively the financier, often not traditional banks, collecting their money from your own receivables, from your own income. The problem with all of these is that they could be quite expensive. So I'm going to say a contrarian thing, which is if you can avoid going out and getting money, if there are ways of bootstrapping, finding other ways of managing your cash flow more tightly, not paying outside advisors like me, like Lewis, too much and too quickly, okay, then that puts off the day for when you will need to go talk to a bank, because you will need to go and talk to a bank, or you will need to go and raise money. But at that stage, hopefully your business is in a stronger stage and your value is higher. Therefore, hopefully you'll get a better deal.
So, folks, thank you so much to all three of you. Are there any questions from the audience?
Question to the panel. I do a lot of activities in Web3. So gaming is very, very common in my industry. What do you think are the actual major barriers in funding for that sector?
Right, let me write down. One exercise as well, it didn't walk me. Who'd like to say this? Go on. There you go.
It's I think like any industry where there's sort of new emerging sort of technology coming through, you know, there's always going to be sort of a certain amount of time taken, I guess, for especially sort of larger students like banks, and it's kind of get heads around it, you know, understand the principle of what's going on, but I guess it's how I differentiates and, you know, what are the other considerations, I guess, that we need to make. So this is going to be the most wishy-washy answer you're going to have, but unfortunately, it's you know, and you know, it comes up a lot. You know, I've talked with so many different companies across the industry. So I think, you know, for us, we have to just kind of monitor where our sector is going. It said, you know, things will pop up. It's going to be buzzwords, Web3, metaverse, whatever it is that are going to come through. And it's just trying to figure out how does that incorporate itself into what we can do as a bank. So that, you know, it's yeah, Chris said it is a bit wishy-washy, but you know that we have to just track, you know, some of the key factors in some of these new areas, and just make sure that, you know, that we can get comfortable with some of those as well. But we are open to have some conversations early enough. One, because we can understand more. So the more we talk to people like ourselves, it's better, because you know we need understanding, you know, people like ourselves who are working in it day in, day out, and then we can sort of take that conversation internally.
Yeah, well, no, it's just reiterates what else is. I think in new industries when there's not much in terms of external data, it takes a lot for investors to try and get their head around what the proposition is. So being able to communicate that effectively, being able to point to sort of research and third-party data is obviously very, very helpful for that. I think over time there will be an attraction of investment. So it's sometimes a slow process, but it's something.
Mark, thank you. Please, Stu, you are the last one.
Okay. It's not a deep end, actually. Got to remember that games is of all the creative sectors, in my view, has always been at the sharp end, the leading edge, really. Technology, and remember, fundamentally, it's all games businesses are technology businesses. So, you know, you take Web3, or you take, you know, let's say you take the NFT market, crypto or blockchain generally. So much of the largest deals, particularly over the last 12, 18 months, have been games companies which have had blockchain NFT type angle. A lot of it was silly money. So I would say that for games companies are in as good a position as, frankly, as any other company. You know, they say that it's usually with new technology, I'm allowed to say this, it's usually porn that drives new technology. Well, actually, I'd say games is a pretty close second. So from that perspective, it's an optimistic, you know, don't be frightened of the new technology. Against that, though, everybody knows that, I mean, the news is obviously full of it at the moment, that what seem to be riches and, you know, again, fear and greed, you can't lose out with Web3 or metaverse or blockchain or whatever. Suddenly, in a downturn market, which is what we're beginning to see at the moment, those deals are incredibly hard because effectively the investors are investing and all the bankers are lending on gold dust. Okay, so it's quite interesting. If you'd have asked the question 12 months ago, it'd be a massive thumbs up. Okay, so now as we're coming to the end of this year, and I think next year is not going to be much different. It's possibly more difficult answer. I've actually got a number of clients that have been in the sector raising money. We're doing gangbusters up till about 3 months ago, and suddenly it's all gone quiet. It's worrying.
Thank you. I think, Sam, are we good? Yeah, one more?
Yes.
Right. Oh, yeah, one more. Okay, where am I going? This is great. Who am I going to?
Hi, thank you very much. Really, so we're glad it's on hourly rate. There's so much information. Right, so the games, you mentioned T17, Debbie, I want to talk by Debbie, the owner of the blog, and she mentioned T17 listed in it's 6 months, but she is sort of iconoclastic. He had run stores in Oxford Street, all GPs, growing up in the 80s when there was some box retail stuff, and he was the hero character guy. So Steve Jackson, he's a fighting fantasy, and he starts with magazines, he's doing it on channel, it's an amazing story. So how much of the rating is the charisma of the person doing the rating? And then generally those guys start to learn organically. How much more sophisticated do you have to be as a games person now with the board of advisors and the CFO and the CRO and all those types of things before you can start thinking about these advanced finance options?
Thank you. This is the team one thing. Right. Who'd like to take this one on? No pressure.
No, I think it's a good point that you raised. I think what I'd point to, especially around sort of earlier stage companies, is having businesses where you've got a management team who've an established track record of delivering commercial success on games is definitely important. And I think when you come to sort of later on down the line in terms of the life cycle, we look into this. I think no investor is expecting someone who's in a creative industry to become sort of really corporate savvy overnight. So surrounding yourself and sort of having a layer of management that has that ability. And as you go through the listing process, you naturally will pick up how to become a bit more corporate savvy and how to basically embed a corporate strategy around business. I think what a lot of the people that list their businesses, that's one thing that we recognise. I think so a lot of small independents coming through listing, going through that process, setting around the governance and internal processing has helped. And over time, as you become as you go through the reporting cycle, you sort of learn through experience. I mean, it's from the investment and sort of debt side of things, fortunately, the experience of the individual, engaging and having this conversation is always going to come into that. And I think when you look at, I've seen some investment this year, which has clearly been done originally on the individual behind it, because there was nothing else. So, so I know we're getting literally people did, but really seems to kind of get that sort of level of investment. So yes, there is that, and I think that where we are coming in, I mentioned earlier, is that network. So who can we bring into a business to kind of help alleviate some of those concerns or worries, where how do I start to have those conversations? There are so many sort of people willing to help. So I think don't overthink that bit too much, because there is so much support, so knowledge out there, and I don't think I've ever had a situation where someone's like, no, sorry, I'm not interested. At least a conversation, they might be able to have all the answers, but at least as I call it, the domino effect of conversation. You need to keep that
growing at a reasonable pace. Because obviously it starts to go very quiet, then obviously they start to dry up maybe a little bit. So that's what we're here to do, bring those, help you facilitate those conversations, and we say you're about to keep things moving at a good pace.
Last one, no. Everyone can go on, so it's
Remember that, whether it's a financier or an investor or even market, what they're really looking for is the product of the business. So, the fact that somebody has charisma, sure, that's an advantage. It opens doors, it attracts people, but, that's cover them, whatever. What they're really interested in is what's underneath the bonnet and, frankly, the performance of the business. Okay, that's the first thing I'd say. Second thing, I remember years ago, so many studios as opposed to publishers seen as effectively, techies who couldn't understand business. Many of them got absolutely screwed on deals, no doubt about that. If you look at it now, I'd say the landscape has almost completely changed. The sophistication of many of those studios, what's happened? Well, there's still excellent tech people in the business. But the difference is that they've usually either learned or surrounded themselves with smart people. Okay, whether it's a non-exec investor, put a bit of money in, but he's been around who can, show them the ropes. And a good accountant, this is me speaking as a lawyer, absolutely critical. Absolutely critical. Because they keep the show on the road. More to the point, if you're a banker, if you're an investor, or if you're even a potential acquirer, if you don't feel that somebody's frankly looking after the money side properly, you're going to significantly undervalue. Third point, you mentioned Ian and you mentioned Debbie. Both of them, as Neil mentioned, they're not. I hope they don't mind me saying this, but they've been around for a long time. They've got two things in their favour: experience and age. They've had also the school of hard knocks. Both of them have had difficult times. That charisma doesn't just come out of thin air. The final point is, if I meet somebody that's full of charisma, that's great, but I'm a bit suspicious.
I think we're good to go, yeah. Sam, you're more than welcome. Everyone can go upstairs. Okay, cool.
Thank you very much. Thank you very much. We've had quite a few comments online saying it was very informative. It's a tough subject, but I think you really got to the heart of that. So thank you very much for doing so. Making his way to join me down the front door is really crossing ground. We found a second microphone.
I desperately want to run down the stairs.
Don't do that. Don't do that. Don't do that. Even Bruce Yates, pray to the birth.
Can't do a tap down.
While I'm getting the mic set up, feel free to do so. Right. Is that working? No. But how can I read my questions? That's impressive. You're not connected. I'm going to do that. So I'm delighted to be joined by Nick Button. French. Just tell us who you are.
I'm a 25-year industry veteran. I started at IDOS, which was listed at the time. So I started in listed companies. I went through EA, Crytek. I helped raise money at Probable, which was Profitect Unicorn. I then started helping out startups. A couple of years ago, I set up a game taking group. So specifically to help startups, give them kind of early stage investment with advisors. At the same time, I help out a few companies like Outright Games. So I've been at Outright Games for 6 years, which is on the road that you've seen. We took private equity money last year, and yeah, we're I'm interested. I'm looking at the numbers going. Yeah, all right, I can see those multiples. That's fine. And so yeah, and that's I help out a few countries around the world. And generally, just spend lots of time chatting.
And it's for those, I suppose, 3 reasons out of that I've asked you to come here today. One, to hear your view on the investment side. It's fascinating. Secondly, to hear about the outright games experience where we're helping in a business that secured investment. So that's a really interesting journey, 2 sides at the same point. And one, because I like you.
I love the fact you reached out to outright games to get something to speak and
they said just get into it. Yeah. That's brilliant. Are you the spokesman, the official spokesman for Outright Games?
I am the executive chair. But yeah, to be honest, I do a lot of the public stuff because I can do exact sense. I really need to build time.
I think we're doing all right for time, and the pizzas have arrived, so we do need to move on with to do so now. So looking at your role as an investor, then Nick, so very broadly, as an investor, what do you look for in a games company? What are you expecting to see and hear when you meet events?
I mean, I do a lot of angel investments at a very early stage. At that stage you're looking for team and business opportunity. You get a great team that because there's going to be bad days, you want the team to be able to respond to that, be able to see what's happening. It's all about that kind of monolithic team, and actually that goes forward to the later stage as well. You build that team over time, and yes, they've evolved and changed. It's not the same team that starts off as a startup and taking things like that. But also business opportunity. Is it a clear business opportunity? Is there a clear opportunity you can work for? You can see where this company can own that space. I'd say particularly right now, we know the investment market is soft right now. So you're looking for, I'm still angel investing, and I'm looking for things that are actually going to be interesting in 2 years' time. On the basis that we think the market is balanced by then. So actually, what's going to excite people in 2 years' time?
And so when you say sort of opportunity, you can get your crystal ball out and have a look at that and really think hard about that, or are you expecting the companies to sort of take you through their vision? In this case, where you buy into their vision.
It has to come from them. You can't tell them what to do. And I do have some companies will try and tell you the thing that they think you want to hear, and that never really works. They genuinely have to. They're going to have to spend ridiculous amounts of time pushing this, making it work, finding ways to just kind of refine every part of the business. So they really have to believe, and if they're asking you what you want to hear, it's not going to work.
Okay, so let's say in the room we've got prospective studios that want to approach Dave Brown about getting some money off it before they leave tonight. Are there any sort of must-dos and mustn't-dos? Are there sort of instant turn-offs and things that really get you excited?
Yeah, generally.
It's doing in a studio, so there's things like that.
Generally don't ask me what I want to hear. You have to have vision, you have to have a story. If you don't have a story that you can encapsulate quickly, maybe I'll buy it. But when you need to raise money in 12 months, you've got to have that story now. When you're going around talking to the researchers and the investment fund, you've got to have your story. It's got to be really, really clear. It's got to be able to be said in one sentence as well as in a half. We're all, the human race is great at telling stories, and we're lousy to make out. We've been doing stories for 3,000 years.
So what's the best story you've heard from against you?
Many good ones. And you're not always right. Your angel investing is a portfolio approach. What's the best story? To say outright, we're going to make kids license hits.
By Jove, that's what they're doing.
Yeah, exactly. It's clear, it's understandable. Actually, it turns out that there's a much larger growth than you first look at when you think about that. And it's now evolved. It's gone from kids licensing games to now it wants to be the best monetized family games portfolio. And then you're looking at the value of the portfolio and how you can monetize. Well, I've said monetize twice in a sentence. I'm not getting
But how you connect with the market, how you connect with a varied market, how you're not just going after corporate, you're going after people that older kids that play Jumanji, you're going after family games portfolio includes grads. So actually that's got a really tight demographic in 18 to 30-year-old women. So best family games portfolio includes 18 to 30-year-old women.
Yeah, why not? I'm going to ask you another question about outright games in a second, but we're going to finish the investment bit first before we pivot on that. So, just looking at the current landscape, the current market for investment from your sort of perspective as an angel, how is it feeling at the moment? What's the sort of level of confidence? Are there any things that you're disappointed that are not coming your way, or things you want to see, or things you don't want to hear any more about? What's the current landscape?
I mean, the investment market is a bit soft right now. So people are being more cautious with their money, particularly kind of funds. Things are taking a bit longer to go through investment committees. They're thinking about it a little bit more. Maybe their criteria is a little bit tighter. Certainly, valuations are a bit lower. Some things which would have had a much higher valuation. Not through the floor, but 20% off, maybe 30% off from what it would have been before. There are always trends. It's kind of interesting that gentleman that talks about kind of Web3. That was a really big trend. Anything that Web3 in the cycle was raising really easily. Metaverse is great. Everybody's looking at the metaverse. We've talked about the metaverse since Snow Crunch. That's the 80s. So these are not new trends. It's just sometimes the time is right for these trends. As an angel, I'm going to predict what the trends will be in 2 to 3 years. As a kind of investing company, then you could respond as things change. I mean, I think Web3 is a great opportunity. I don't think it's just in terms of the value. This value of this token is going to increase, but if you're using Web3 to build a community, if you're using Web3 to build permanence with your players and belonging and a sense of involvement, then I think that's really interesting. So it's finding the way that business is going to make sense in the long term, not just following the current buzz trend.
That's interesting. I mean, and it must be tough to know what the next trends are going to be. I suppose you talk to enough people, meet enough people, so go to lots of events like this, read lots, hear lots of speakers.
Certainly you start to feel a kind of force behind certain things. That was a year and a half ago. You could feel the Web3 stuff building up, and yes, it got very quick. And you get it wrong. I mean, I thought 3D TVs were going to be everything.
I don't even know what is that.
I still got one.
You trying to sell it? You trying to check it out?
But it's not about the buzzword. Your virtual reality was great. I was a VR naysayer. So I just used to get rolled out of the panels just to go, you're all idiots. The emperor has no clothes on, and everybody else would laugh at me and think I was stupid. And basically, I was going to VR conferences, telling them that the emperor has no clothes on. But actually, now I think VR is an interesting business. The world has changed a lot. The people that are using it, boys aged 11 to 16, a lot of them are using VR. That's a really good market that you can target. All of a sudden, you've got a concerted market that you can aim products at. So now I like VR. So some of it is just timing. Now, the people that put their time and energy into VR, many years ago, actually they've still got that knowledge. So those businesses get much more interested. And I think that's supposed to be best, but they're generally gating.
Let's move on to the sort of the outright games experience then. So how would you describe outright? You've talked about, I'd like to hear a little bit more about the business. But we understand they do license IP, a lot of console content. I might ask why there isn't a digital strategy that's visible yet in a second. Is that a cheeky question?
It's not a cheeky question.
I might come to it in a second. So what do we need to know about outright games? What's for their background? How did they get you involved as well?
How did they get me involved? The original investor was a group called Rockpool, and one of my old friends used to be next door to the guy that was helping them raise money, and they needed somebody from the games with them. This recording goes out, I think it's trouble. And they needed somebody from the games business to kind of have an oversight. So I was brought in as a kind of non-exec director. I went native. because I really like the business. You know, it was a business that made absolute sense that I've been thinking about for 15 years. And somebody was actually doing it. So I got to join, they did all the hard work and I sort of ignored it, which is fantastic. That's the way you should do it. Timing is important. Timing, yes. So yes, that's how I got involved. I love the business and, you know, 6 years on, got a really interesting business.
So let's talk about the transition of that business then. So what was attractive about Barclays to external investors? And did you actively go and court some of those investors to come in, or were people knocking on the door? How did it work?
So I mean, the initial investment was cash was needed to buy the licenses to fund the development case to start building a portfolio. Then after a few years, that portfolio has some size, and you're then when you're looking at strategic opportunity, you're looking at streaming, game streaming. Well, if you ask people at Netflix, they took out subscriptions to House of Cards, but they stayed because their kids were watching. Yeah, if you know, oh well, you're in the middle of the series, you can't stop. I was like, fine, we'll do it next month, and then you forget. So kids' content is very, very sticky, and you know, outright it makes kids' content. It makes sticky kids' content. So that's fundamentally why the business is so attractive. I mean, lots of recognizable, understandable kids' content, generally with brands that kids love.
Yeah, recognisable brands that aren't cheap to secure in the first place. Or are they?
So they're not cheap to secure, but it's not the previous incarnation of this kind of kids' licensed games got too frothy. You know, people, I think there was a THQ deal, going to get the numbers wrong, but like 10 million a game for a Pixar license. Funny enough, THQ did not make money on that and went bust. But if you're sensible, if you build an efficient game for your target market, you know, a 3-year-old that's playing Paw Patrol just wants to have an adventure with the pups. You know, they don't want incredibly complicated mechanics. So you make a game where that 3-year-old is having an adventure with the pups. You know, the Bratz game is it's a game that works for people that really like Bratz. And it's kind of it's a simple business, but it's taken many years to make it this.
It's quite a well-defined business. You understand what they do when you meet the people, when you look at the website, when you see the products. It's got a very clear message. So let's talk about the investment then. How did that come about? What was the process?
Yeah, I mean, it's so we had an original investor. The original investor, as with all funds, was looking for an exit. You know, we had a good, profitable business that was cash generating. They wanted investment, so we actually went through a full process with advisors appointed, and you know, lots of pitches and building up lots of decks and packages and exactly that kind of establishing the management team to progress. And we went out and did a kind of formal sale process, and we ended up with a party that preempted the process, which was great because it meant they really wanted it and we really wanted that. And you know, we have a really good partner who's helping build the business going forward.
And what's the outcome for outright of this? You're using that investment for growth. It's the strategy.
We haven't announced much yet. You know, we're looking at constantly building that portfolio. We're looking at expanding the ways that we can monetize. I've got to stop. I can say that about this climate, but anybody else, it's all about the quality. It is all about the quality, building fun experiences, but fun experiences that ultimately can be monetized. So yeah, we're building capabilities, we're building processes, we're making sure that actually we can make great games, but for an appropriate budget. You know, you're not going to sell 10 million of a kids game. Well, you can sell a good, predictable number. You know, Walmart will always take this amount that will fill their shelf. We did a game with Ryan. I don't know if anybody you know Ryan. He's an influencer that opens boxes. And he's got a great number of followers. You know, eventually he's aging up and he's not, you know, you hit him at the right time. We made a game, and Walmart wanted him to make a game with us that went on all their Ryan shelves. And so they had a bunch of Ryan merchandise, and there was a Ryan game as well. And so it was a game that was right for that time, and it was an appropriate game for the age group that liked Ryan. So it's about not doing anything stupid. You know, it's about being sensible. You know, when you're asking a question, somebody asks you a question like, is this a good idea? If the answer is no, don't do it. It's amazing how many times and how many crazy CEOs I've worked with that have ignored that message.
It's not always easy to distinguish though, is it? That's the challenge.
Yeah, I mean, you don't get everything right. But as long as you get enough things, so you take an appropriate number of risks, you understand the risks. And if it's an appropriate number of risks, actually you end up with okay.
I'm sure I've seen in the press you've been investing in other studios.
As you asked me that question, I don't know what we've announced yet.
So should we just say, check it out, they've been invested in other studios, if you can find it publicly, then
We're always looking for opportunities.
it makes sense though, doesn't it? You're trying to build a business which can work on multiple levels, and have the infrastructure that you need. So you're using that investment productively.
Yeah, so we're building a portfolio, which means we need capabilities around that portfolio. So yes, if there are things that help build that portfolio, that means we can exploit that portfolio better from a business point of view. Fantastic, and there are plenty of opportunities out there. You know, where having a good private equity backer means that those opportunities are available if they're right. That doesn't mean it's easy. You know, the numbers have to make sense, the opportunity has to make sense. Yes, and we are looking.
What's the pressure like for the backers?
I know it's more the pressure on us. I don't know whether we got lucky with a private equity house, but they hold things longer term. They're not necessarily one of those houses looking to sell it within 3 to 5 years. If you look at their portfolio, they hold it for 12 years, and still get an exit at the end of that. So that means we don't have that same pressure. We are the ones creating the pressure because, we think we've got a great opportunity and we need to take advantage of that opportunity right now. The opportunity will have changed in 5 years. And so we need to be in a good position now to be able to take advantage of how that opportunity is evolving and changing.
I was going to question you on a digital strategy because you're quite console focused, which makes sense. It's a consistent business, but I don't think it's much on mobile, I don't think it's much on digital yet. So
we do have quite a lot of digital, but it is console facing. So we're doing a lot with Game Pass, we're doing things with Amazon, we're doing digital distribution through Sony and Microsoft, but we're still selling a good number of units in Walmart, Target, and things like that because granny money.
You've got your own shows.
We do have our windows. Yes, we have our own standees and the range. Now, and we're building a portfolio that by the end of next year we'll be over 58. Now people talk about IP, and it's not necessarily about the IP itself, but it's about the asset that has value.
That is interesting. We talk to a lot of investors, they are looking at studios that have their own IP that they can invest in, and you don't have your own IP.
I think that's a little bit old fashioned. There was a few, it was all about owning your IP. IP was everything. But actually the definition of who owns the IP is always a bit vague. You've got to deal with your publisher that means they've got exploitation rights over it for the next 3 iterations to really own it. That list keywords don't own IP. Sumo just sold out for a lot of money without really owning their own IP. But I think it's generating assets that have that. So I think the IP thing is that's how people looked at it a while ago, but actually then that's almost a riskier business if you're building your own IP. What you want is a nice, stable, repeatable, understandable business.
Lovely. Are there any questions from the audience for Nicholas?
You want me to do a tap dance?
No, we're gonna try and avoid that at all costs. No, one final question then. A bit of if you talk about sort of your long-term ambitions as a company then. What should we be looking out for? What's exciting you about what Harbottle are going to be doing in the next 5 years?
Well, I'm going to answer it with 2 hats on. So I'm going to answer it with my angel investor hat.
All right, go for it.
Which is, I just want to have fun. Angel investors, yes, there is a financial return, but it's kind of the journey. You're looking at investing in things that actually you want to be part of. So you want to be part of that journey. And some of them will work incredibly well, and some of them will carry on and build different businesses and evolve sensible object. We pivoted 3 times and eventually sold to Niantic. Because by the 3rd pivot, to be honest, everybody's really tired. So it's being part of something interesting. Now with my own games hat on, I want to build the best monetized family game portfolio. You know, I want us to make games where I brought my kids up. Both my kids played the Lego games. You know, so my first one played Lego Harry Potter. I had great experience sitting down with her, we're playing games, and it was fun, and I loved it. You know, that's part of. I have a special relationship with her over that. I did the same with my son with Lego Marvel Superheroes. I want to make those games where, you know, parents have those kind of relationships with their kids, because that makes, you know, that helped my relationship with my kids, and hopefully we can kind of help other people's relationships with each other and their kids.
What a lovely sentiment. Thank you very much. So that brings us to the end of all of our speakers this evening. So I want to do a couple of very quick thank yous. Firstly to the venue, but the team for all their help for accommodating us here this evening. That's the Barclays team, so thank you very much to all of them. Thank you to our speakers. So Neil, Ryan, Gavin, Mark, Imelda, Elaine and Nick. Thank you all to them. But most of all, thank you for coming on and joining us here this evening. Pizzas and drinks are available up there, so go and have a chat with each other, make some new friends. And thank you to those online who stuck with us and posted a few questions to me as well. So thank you very much.